Hey guys, it's Ryan Brooks here. If you've been watching the market slide lately and thinking, is this the start of something bigger? Should I buy? Or just wait it out? Then you're in the right place, because today, I'm going to show you why this pullback might actually be one of the best buying opportunities we've seen in months, and how you can invest smarter, lower your cost, and stay safe even in uncertain times. The market has been dropping pretty sharply over the past few weeks, especially in the last few days. But honestly, that's where opportunity hides. In this video, I'll break down exactly how to lower your average cost on both stocks and options, so you don't need huge moves to make real gains. What I'm about to show you is powerful. I'll walk you through a few names that look attractive right now, but remember, every trade has risk. Never put more than 10% of your portfolio into a single stock, one sector, or one options play. Stay balanced, stay smart. I'll also show you a better way to think about this market, how to use psychology and patience to dollar cost average at the right times, because at the end of the day, this all comes down to mindset. When there's fear everywhere, when everything looks red, that's when you start planning your move. You wait for stability, and then you enter strong, quality stocks carefully. If prices drop further, that's when you add more strategically, not emotionally. Let's get into it. There's a lot going on in the world right now. Headlines, uncertainty, and mixed data, and the market doesn't like uncertainty. But what's interesting is how predictable this kind of fear really is. Big institutions have been calling for corrections in the next 6 to 24 months. That's such a wide window that anyone could make the same call and eventually be right. In fact, we've already had 2 big pullbacks in the past year, so this isn't new. This kind of talk often shakes out retail investors, and what happens next is that big money steps in quietly and buys the dip. We've seen it over and over again. Look at recent earnings. Some companies crushed expectations but still sold off. That's what happens when fear outweighs logic, and that's where opportunity comes from. Here's what I think. When the market overreacts to fear, that's where disciplined investors win. Big money always finds its way back, and they buy when others panic. So instead of chasing green candles, you buy the red ones. That's how you win over time. We also got strong data this week, better than expected, which is a great sign for momentum. And as more clarity comes in around policy decisions and rate expectations, we'll likely see volatility calm down and the market start to recover. If we get a small rate adjustment by the end of the year or early next year, that could be the extra fuel the market needs to climb again. Now let's talk about Meta as an example. I told many of you before the last earnings that it would be a strong report, and it was. If you traded it before earnings, there were plenty of profit opportunities, but holding options through earnings, that's always a high-risk move. If you were caught in that, here's how you fix it by averaging smartly. Let's say you had long-term call options and the price dropped. You don't panic, you wait for the pullback to stabilize, then add more contracts at the lower level. That brings down your average cost. For example, if your initial options were around 11Ks and they dropped to 6Ks, you can add new ones lower to bring your cost average to around $7 per 100. The stock doesn't need to shoot up to all eyes, it only needs a moderate recovery for you to break even or profit. When the price moves back into the upper 600s, that can easily translate into several $1,000s in profit per batch of contracts. That's the power of averaging down strategically, not emotionally. The same logic applies to Navy. Right now, the stock is sitting in a great range, around $8.50 to $10, and that's exactly where I said I'd be buying. Anything under that zone looks like a strong long-term opportunity. Ignore the noise. Yes, they've shifted away from some smaller areas, but they're doubling down on next-gen computing and data infrastructure, and that's where real growth is happening. You're not investing for what's happening today, you're investing in what's coming next. If you can see a pullback as opportunity, you're doing it wrong. Don't chase big green candles. Buy into fear. That's how pros do it. When prices drop, that's when you step in carefully. If you do that, your average cost stays low, and when the stock rebounds, you don't need a huge move to be profitable. Right now, Navy under $10 looks great. Same goes for solid names like ARM, Microsoft, Meta, Shopify, and Nvidia. Even higher risk plays like MicroStrategy could pay off big if you can handle the swings. As data improves and confidence returns, we'll likely see the broader market recover step by step. If rate adjustments happen sooner and market conditions stay steady, stocks could move higher into next quarter. But again, be disciplined. Never put more than 10% of your portfolio into any single trade. If your average cost is below $10, you're probably going to be near break-even or even profitable within the next few months. That's not wishful thinking, that's how smart investing works. So, stay patient, stay consistent, and keep your head in the game. If you found this breakdown helpful, make sure to hit that like button, subscribe, and turn on the bell so you don't miss my next video. I'll keep bringing you weekly updates, deep market breakdowns, and real-world investing strategies.